Hello everybody and welcome back to another video. In today's video, we take a look at the stock, commodity and crypto markets right now, but we also focus in on the gap fill that just occurred on the biggest market in the world, the US stock market. Basically, a gap fill is an incredibly important area or zone. It means that an inefficiency has effectively been filled. And at that point, sometimes you look for turnarounds. Now, we didn't get it in the last 24 hours, but what we did get was a coiling effect. And as most technical analysts out there know, that when we go into a coiling, distribution or accumulation effect, the explosive moves out of that coil can be big. So whether it's up or down to our trend line or to new lows, well, of course, a trader needs to be prepared for all these scenarios and we'll take a look at them. The other thing we've got today, which is very exciting, is a bunch of different macro charts that I think a lot of you will find interesting. And of course, one of those always leads to a recession. So stay tuned as we cover it all together in the market wrap. See you very soon. Well, welcome back everybody to the daily show here where we talk about stocks, commodities and cryptos. Before we get into the recession risks and talk about the technicals and option charts, let's just quickly say a big thank you to the sponsor of today's video, which is Tiger Brokers. And they have a special offer for you later on in today's video that we'll be talking about. So stay tuned for that. Let's talk about recession straight away here. And of course, bounces that often are short-lived within recessions. We saw the bounce, we kind of predicted it together this week, and we started to say, well, is this a dead cat bounce? And is this something where, yes, we're seeing a potential bull trap? Go back and have a look at some of the other videos we've done. We talked about it. Now, we could still be in a bit of a bull trap, and history would tell you that around this period in time, that is where we begin the SP 500 decline, we tend to have a little bit of strength around this period. This tends to be that period where the bull trap comes into play. So depending on what happens, especially in the next 24 to 48 hours, we could be in a longer lasting bullish move here that could still be part of a bigger bearish bust. And this is why it becomes so important that we read technical signals that tell us that we are, yes, in a fully fledged recession. What are some of the things that you always go to? Well, 100% of the time, this particular indicator has worked, and that has been basically bond yields. If you see inverted yield curves, this is a huge deal. I like to use 50% plus of yield version, and this is basically the best indicator out there of proving that a recession is coming. Oftentimes it will happen before the recession as well, so it's very, very early. This year, of course, there are things at play that are a little bit different to normal, but realistically, all the way from the 70s here, you can see that when 50% of bond yields inverted, it always led to a recession. And that's something that's very important to stand out. At this stage, at the time of recording, we're sitting around just under 30% of all bond yields inverting. And this means things like the 2-year, 10-year, 3-year, 10-year, 5-year, 10-year, and all these types of different inversions are occurring. Go back and watch some of our videos as well if you want to find out more about that. Let's talk about oil price shocks as well. A lot of you will say, well, oil always proves recessions as well. And every time we've gone over $100 or every time we've gone over a certain amount per barrel, it's caused a shock and a recession. Absolutely. Another way of looking at it is oil prices relative to its 5-year moving average. So here we've got the black line. You can see the 5-year moving average. And you can also see that when oil tends to spike over this level, which we're getting very, very close to at this stage, it tends to mean, yes, the recession is here, and we're already usually in it at that point. So this is a very big point as well that we should be pulling out when we're talking about markets right now. If this goes through that level, well, guess what? It's pretty much that we're in a recession. And of course, if we get in the bonds yields inverting at the same time, then of course we are, and you might want to think about cheaper prices in the markets. Now, recessions can last for a long time or they can last for a very short time, but we tend to usually go into a recessionary period and then we end up basically going all the way down to usually new kind of lows. And what that means is that when we find out about the recession, there's usually a little bit more to come in these markets. It's not like, oh yeah, we're in a recession, that's the end of it. 2020 was unusual, and we know it's because the Fed backstopped this market. So you need to think about forward PEs as well. What's a cheap forward PE from an investment standpoint? Well, maybe it's something around a 12 or a 13 or a 14. You need to think about Schiller PE, which we'll be bringing in later in this week's video. If you're not familiar with it, definitely subscribe because we'll be talking about that. So S&P 500 valuations do matter. And at the moment, while it's cheaper than it has been in forward PE, it's still expensive based on the history of the last kind of 20 years. So just always keep that in mind, especially when we're on the teetering brink of basically going into a recession. Some figures are showing us upwards of 85% chance now that we're already in one. And of course, oil is very, very, very close to that 5-year moving average. Let's talk about monetary supply. Why has all of this happened? Well, we know it's inflation based, but we also know that the Fed turned the tap off and we're all the way back down to zero. So this has tended to coincide with some weaknesses in markets. And of course, monetary supply, or the money supply in general, has been turned off. The tap's been turned off. It's not news to any of you. Now, what makes this recession a little bit different to others if it does happen? Well, a lot of it has to do with US households' net debt in billions. We already know that there's a lot of cash being held by US households. And it says here, US households have $2.7 trillion of net cash available. So we could be going into a recession where it may be a little bit more mild than you might think. And yeah, hear me out here. It could be more mild this time. But what will probably happen is we may go into a recession. It might be more mild. We'll come out of a recession. Think about the 70s and what happened here. The Fed will be raising rates the whole time, and then they'll move to a cut. And when the Fed moves to a cut, it's a big, big deal because, of course, whenever they've done that in the past, they've usually stuffed it up. And the cut actually has caused another recession. That could be the biggest one. And I expect that to be the kahuna if it does end up occurring in this certain way. And that could push us into something like a 2026 or 2025. So yeah, continue to follow along because we'll be really breaking down that concept over the next coming months on the channel here. So before we go any further, let's take a look at the markets themselves in the last 24 hours, and we'll get into the charts in just a few moments. And basically what happened was a sideways action. You'll notice that the Russell 2000 was a little bit weaker, but the big markets, the Dow, the Nasdaq, and the S&P 500, they all coiled through the entire session. Yes, there were still transactions going on. So what does that mean? Well, there's a lot of orders being placed. Now, whether those orders end up being to the bearish side or the bullish side, we don't know. But of course, the algorithm and on top of that, the composite man, that is the entire market, will have been placing positions, no doubt, for a nice breakout. Let's hope over the next 24 hours. Let's now take a look at what's happening with the sectors in the markets. And one of the sectors that many of you have been following has been the biotechnology sector over the last couple of weeks. If you actually look at the percentage change over 10 days, it's been very strong, 11.69%. And by the way, this is a great segue for us to talk about the sponsor of today's video, Tiger Brokers, because we're using their platform right now to take a look at all of the heat maps of the different sectors in the US stock market. I absolutely love this feature, and I think it's really, really cool and definitely available to anybody that's opening an account with Tiger Brokers. Biotechnology was one that was picked by the community a few weeks ago, and it has been one of the best performing over that period of time. Another couple of good features for Tiger Brokers, of course, their premium news feeds as well. They do subscribe to a bunch of premium news feeds. So that's Dow Jones, Reuters, Bazinga, and Redbox if you're interested in any of that news. And at the moment, there is a special offer for limited time, which I believe is up till the 11th of July, where Australians, especially if they're wanting to open an account with Tiger Brokers, can get one free share of Apple and a bunch of other extra perks, which you can look at in the link description down below. If you're anywhere else in the world, though, there's plenty of different countries that Tiger Brokers are in, so you can have a look and click the link in descriptions if you're interested in the platform. But let's get into the technical analysis now, and also a thank you to Tiger Brokers for sponsoring today's video. So let's break down the markets right now. We'll start off here with the VIX. Not really too many moves in the fear index at this stage. It's sitting around 28.15. It's not back at the 35s just yet, but certainly at an elevated level. And as we know, when VIX is this high, anything can happen. The market was lackluster in the last 24 hours, but there were a couple of positive signs. The first one was the 2-year dropped a little bit. This is the US 2-year. We also saw the 10-year dropping marginally. And if we bring that on a chart and you notice here, there's the 10-year and the drop that occurred. Now, we do want to see these continue to reduce. And if they continue to reduce and you're seeing the stock market still in a coil, it kind of helps to kind of predict in some ways that the market might be breaking to the upside. And if it does break to the upside, for that to be a more valid trade. But the counter to all of this were two things. One, we saw an increased amount of puts entered into the system. The put call ratio here increased at a pretty fast rate. We got to a 1.24. More on that later in today's video because there's quite a lot to discuss there. And we also saw an increase in the US dollar. The DXY increased quite substantially after it broke through that trend line the other day. Now, the dollar index kind of looks like it's changed trend now in some ways from the previous kind of movements. Maybe it's gone towards bullishness. I think it's all very questionable here what's going on with the US dollar, and I've said this before. There has been maybe a trade, that breakout, you could have certainly traded up until these highs, but at this stage, this could be all part of what we call a larger schematic that actually is distributing before weakness. So US dollar is helping us, but to understand the previous session, it was all about strength in the US dollar, not weakness, and that led us to not being able to break out on that US 500 pattern. So let's talk about gold, and gold's looking a lot better than it was. Of course, you can see here the huge breakout when it got past these candles, these wicks here, the doji as well. All of those usually hold orders, and we saw it early in the session breach through. It's then pulled back, and this is not unusual for it to do so, even if it is in a change of trend to the upside. But gold's looking a little bit stronger here in the session, and this break was a fairly large deal. So yesterday in the previous video, we talked about it pulling back. It's pulled back a little bit deeper than you would usually like, but it does look a little bit longer and stronger on the charts, especially based on this breakout. And for many traders, this is what it's all about. Seeing the breakout, seeing the pullback, and then taking your position in long. That tends to be what algorithms do. Remember, we're looking at gold versus the US dollar there, and sometimes it pays to look at gold versus other currencies. Here's gold versus, let's say, the Great British Pound. You'll notice it's a totally different chart. Whether it's gold versus the Euro, Great British Pound, or anything, sometimes the same pair or that particular idea could be good, but you're picking it against the US dollar rather than others. Let's talk about oil now. So did oil start to break down? Well, let's look at the daily. The daily was a pretty decent rejection here for oil. You'll know I'm kind of bearish on oil at the moment, even though most people in the world are bullish. And the reason why is because I think we're in a bit of destruction here on oil. We had the OPEC meeting. The big thing I can notice on the charts was that we actually changed the first directional time frame trend. So that basically means that we now expect a pullback, but we also expect pullbacks to be shorted here. This is the first change of trend that we've seen to the negative side ever since we broke through here. So basically all of this was all bullish, and now suddenly we turn into a slightly bearish looking market here on the 1 hour. And pullbacks we would expect to be shorted, something around that 112 or even this area here around the 111. They could be interesting areas for day traders and scalpers to look at and, of course, break down with their own systems. We'll move over now to the stocks. We'll talk about Tesla. Look, Tesla was a little bit lackluster. It broke through and went a little bit lower underneath the 690. Maybe it was trying to fill this gap underneath. Tesla is, I would say, very difficult to trade on the longer term at the moment for swing and things. This kind of just looks like a massive level of accumulation or possibly even distribution. One thing is for sure though, if you're a Tesla trader or an investor, you need to be very careful if Tesla breaks underneath 620. And of course, you might be fairly happy if Tesla breaks above 780. This is, at this stage, a fully fledged channel, and it has so many different things going on. If the stock market breaks up, expect Tesla to obviously outperform the stock market as a raw percentage. But if the stock market breaks down, based on the weakness we saw in the previous session, I would think that Tesla could move all the way to the 620 fairly quickly. So there could be also shorts to be placed there. Let's look at the DAX. Not too good, yeah? We talked about this in the previous session, and the DAX is... This is the German market for anyone that doesn't know, the German 40. This is a very weak looking style section of candles. Now we're still on support and we're still technically holding up as best as possible, But if you ended up getting a candle that broke through these areas, this would take out a whole bunch of orders that were sitting there in supply. I think that would be a fairly large or good sign towards bullish movement. But for now, this is all down at this stage, and I think it would be hard pressed to be bullish on this market until you see some further turnaround. Remember one of our mottos here on the channel: patience, react, don't predict. Try to always look for a reaction in the market, and then you can possibly start to place some positions and orders. So how were things on the Nasdaq? Were they any better? Well, we'll just quickly bring it down here so you can see the consolidation that happened in the last session. Effectively, we're just trapped within a resistance and a support, and everything that happens in here is just coiling noise. Similar to the coil that happened over here before the breakout, we've got a new one. And if the SP 500 breaks out and above, we would expect the Nasdaq to do the same and do quite well. You can see here on the Nasdaq, if you get underneath this level, which is sitting around the 11,500, if that occurs, well, what's going to happen? Not only is the Nasdaq going to fall significantly, but you'd think it fills the gap and shorters would come in possibly all the way back down to 11,200 very, very easily. So the short is certainly a possibility here. This could be all distribution with the idea of going short, and then of course that to be possibly even new lows in the future. Is this all we got as part of the dead cat bounce and the bull rally? Well, the Nasdaq predicted the trend line as we've already discussed before, but the markets that haven't yet have been the Russell 2000 and the S&P 500. Let's take a look at the Russell 2000 together. Did fill the gap, at least the one that it left, similar to the stock market. It's found the previous kind of consolidation area. Of course, it's coiling similar to the rest of the market at this point. A breakout above will be good for day traders and they'll look towards the bull side. But the Russell never really completed the secondary gap. It got the first one. You can see it got the first one here, but it hasn't got the secondary one. That's similar to the S&P 500. So it makes me think that there might be a little bit more in this bullish rally, but of course we're not going to predict that. What we want to see is we want to see the actual stock market, the S&P 500, breaking to one side or the other. Here is the current futures action. You can see the coiling of around a 1% range. Look at when the Fed and the Bank of England and the ECB came out. Up, down, up, down, up, down. Lots of dojis, lots of wicks, and all sorts of action. Break below, where's the next stop for it? I think it's around that 37.40 for the S&P 500, and possibly even lower at that point, all the way back down into this particular area here, which is the 3700. If we break above and we actually move through this area, well, I think that's pretty positive. Next stop would be this range here, which could give us like a 39.15. And if we look at the real stock market, that is the S&P 500, and ignore the futures, this is the other logical conclusion we were coming up with the other day. The bullishness into the downward trend, which would also at the same time fill the final gap that we have sitting here. Now, there are other gaps left behind, so don't get me wrong, gaps can be left behind, but the market does tend to like to come up and fill them. So it's kind of like, let's get it done if we're going to get it done in the next 24 to 48 hours for the market. And I would like to look at some options now together as a community to find out whether we can figure out if the market actually wants to do so. So here's the options expiration for the 30th of June. And straight away, you'll notice for some unknown reason, there are tons of puts sitting at 380. I don't know who opened these. You don't either. I'm sure none of us do. So it could be Wall Street. It could just be a bunch of hedges. It could be anything. But for some reason, the 380 strike has a ton of puts in it. It would make me think, and this is just a hypothetical, it would make me think that the market probably doesn't want to move underneath the 380 for the expiration of the 30th of June. Because why would they want to pay off these puts? And also, why are there so many puts sitting at that level? Something interesting to be looking at over the next 24 hours. And then, of course, as we go into the expiration on Friday, we have some different levels here. So we do have the 380, but it's not huge. We also have the 390, a bit bigger, and we have the 400, which is really huge. So if we did get a rally, well, 390 or even 400 could be all we get for the Friday, because I don't think we can break 400 easily considering how many calls are already sitting here. The max pain for Friday is 385. That would be the perfect options expiration for I guess, the market makers to make the most amount of money. But it's just interesting to see what's happening over the next 24 into 48 and where these calls and puts, the orders lie, what we call the walls lie. If we're looking at cryptocurrency, yep, still at production cost. So this is the production cost chart. Nothing really else other than that. But if we switch over and just quickly click on Bitcoin here together, you'll notice because it's at production cost, people are trying to buy this level. I do think this will move a little bit with the stock market. If the stock market finds recovery, maybe we move through the 20,400 on the Bitcoin, and then at that stage we go up. Notice the wicks here on the 2 hour. There's a lot of orders going through here. Whether good or bad, markets around the world are certainly consolidating at a very critical zone across all of these markets. If you haven't already, come and follow us over on Twitter at FX Evolution is our handle. We do have a Discord community as well with 10,000 people in it, so come and join us there. And if you're interested in finding out more about our private live streams as well, we have a free 7-day free trial for that. We also do have some news ahead, and the news that's coming out, which may move the markets, core PCE price index coming out 8:30 a.m. New York time. And of course, we also have the ISM manufacturing PMI coming out at 10 a.m. Friday, July 1st. As always, guys, a big thank you to Tiger Brokers, who of course sponsored today's video. And if you're from Australia, check out their special down below as well. You get a whole bunch of free stocks for opening an account with them and funding it. And I think that's pretty damn cool. So check it out, guys. It is for a limited time. I believe it finishes on July the 11th, so you don't have that much time to act on it. And have a great day. And of course, if you enjoy the content, subscribe and smash that like button. Bye for now.